Did you know that a single 1 cent move in pound sterling to US dollar can shift the value of Britain's daily trade flows by tens of millions of pounds? That is the kind of scale we are talking about when we discuss the pound versus the dollar, and today, Tuesday the 28th of July, 2026, this pair is once again the center of attention for traders, businesses, and anyone with savings tied up in either currency. If you have ever wondered why your holiday spending money buys a little less some months, or why UK import bills seem to creep up without warning, the answer very often traces straight back to this exchange rate. In this video we are going to walk through exactly what is happening with pound sterling to US dollar right now, what has changed recently, who it is affecting, and where the smart money thinks this is headed next. No jargon, no guesswork, just a clear breakdown you can actually use. As of today, the pound to dollar pair remains locked in a period of elevated two-way volatility, with price action reacting sharply to every fresh headline out of London and Washington. Traders describe the current phase as a battle between two competing narratives. On one side, a Bank of England that is cautious about cutting rates too quickly while UK inflation remains sticky, and on the other, a Federal Reserve weighing how much further it can ease policy without reigniting price pressures in the world's largest economy. This tension is exactly why pound sterling to US dollar has been choppy rather than trending cleanly in one direction. For everyday viewers, this matters because it means the exchange rate you see quoted on a Monday could look noticeably different by Friday, which has real consequences if you are converting currency for a holiday, a house purchase abroad, or a business invoice. Over the past few weeks, the key shift has been a change in how markets are pricing future central bank decisions. The Bank of England's Monetary Policy Committee has continued to strike a careful tone, balancing concerns about a cooling UK labour market against inflation that has not fallen as quickly as hoped, which has kept sterling supported at times when a more dovish stance would have weakened it. Meanwhile, in the United States, incoming economic data on employment and consumer prices has been feeding directly into expectations for the Federal Reserve's next moves, with markets constantly recalibrating how many rate cuts, if any, are likely before the end of the year. Every fresh US jobs report or inflation print has been enough to send the dollar swinging, and because pound sterling to US dollar is essentially a read on relative strength between these two economies, it has absorbed that volatility directly. This is a textbook example of how two central banks moving on different timelines can whipsaw a major currency pair. This is not just an abstract number on a trading screen, it filters into everyday life in very tangible ways. UK businesses that import goods priced in dollars, from electronics to raw materials and energy contracts, are watching this rate closely because a weaker pound directly raises their costs, which can eventually show up as higher prices on supermarket shelves. Exporters, on the other hand, can benefit from a softer sterling because it makes British goods cheaper for American buyers, giving a competitive edge to sectors like manufacturing and whiskey exports. If you are planning travel to the United States, the exchange rate determines exactly how far your holiday budget stretches, and even a small shift can add up over a 2-week trip. Homeowners with mortgages linked to broader interest rate expectations are also indirectly affected, since currency moves often reflect the same underlying rate expectations that shape borrowing costs. In short, whether you run a business, plan to travel, or simply follow the news, this exchange rate touches your wallet more than most people realize. Technical analysts tracking pound sterling to US dollar are focused on a handful of important zones. On the upside, previous resistance areas that have capped rallies in recent months remain the first hurdle for the pound to clear if bullish momentum builds, particularly if UK data surprises positively or if the dollar weakens on soft US figures. On the downside, support levels established during earlier pullbacks are being watched closely, as a break below these zones would likely trigger further selling as stop losses are activated. Chart watchers also point to moving averages as a guide for the underlying trend, noting that when price trades consistently above these lines it tends to reflect sterling strength, while sustained trading below suggests the dollar has the upper hand. It is worth remembering that technical levels are not guarantees, they simply reflect where large numbers of market participants have placed orders, but they remain one of the most widely used tools for short-term forecasting in this market. Looking just ahead, the market's attention will remain fixed on the next rounds of UK inflation and employment data, as well as the ongoing flow of US economic releases including inflation prints and the closely watched non-farm payrolls report. Any speeches or public comments from Bank of England policymakers or Federal Reserve officials in the coming days are also likely to move the pair, since forward guidance often matters more to traders than the data itself. Analysts widely agree that until one central bank sends a clearer signal about the pace of future rate changes, pound sterling to US dollar is likely to continue trading within a defined range rather than breaking out decisively in either direction. That said, markets can move quickly on surprises, so any unexpected shift in inflation trends or labor market strength on either side of the Atlantic could be the trigger that finally pushes this pair out of its current holding pattern. It helps to remember that pound sterling to US dollar is one of the most heavily traded currency pairs in the world, often referred to by traders as cable, a nickname dating back to the transatlantic telegraph cables once used to relay exchange rates between London and New York. Its importance goes far beyond Forex trading desks, because it acts as a barometer for how global investors view the relative health of the UK and US economies. When confidence in the UK outlook improves relative to the US, the pound tends to strengthen, and when the reverse is true, the dollar typically gains ground. This makes pound sterling to US dollar a useful lens for understanding broader economic sentiment, not just a number to check before a holiday. So what is the one thing to remember from all of this? Pound sterling to US dollar right now is being driven by a genuine tug of war between UK and US interest rate expectations, and until one central bank clearly breaks from its cautious stance, expect continued choppy, range-bound trading rather than a clean trend in either direction. If you are exchanging currency soon, it is worth keeping an eye on upcoming inflation and jobs data from both countries, since these releases are the most likely triggers for sudden moves. And if you are simply trying to understand the news, remember that behind every headline number is a real story about interest rates, inflation, and the relative strength of two major economies. Thank you for watching. Make sure to subscribe for more clear, no-nonsense breakdowns of the Forex market, and we will see you in the next one.